Let's walk through a really fun, really cool example here. And this is an example of an AR sale, right? This is an example of a credit sale. Okay. So if you hear us say, or if you hear me say credit sale, we're just talking about AR, right? Again, they owe us. Okay. We earned it, but they owe us. Okay. So on March 1st, again, we're always going to always be mindful of these dates, right? Always just keep that in the back of your mind. Even if you don't end up using it, okay, you want to be mindful of the dates. I'm going to remind you guys every time we see a date for the next chapter, at least during this chapter, that you need to be mindful of those. You need to be paying attention to those dates because they will become important, okay? So on March 1st, the company provides services to a customer for $500. What's happened? Well, we provided services, right? So this means we earned it, which means recognize revenue, right? These are the kind of things you need to be doing as you read these problems. Pick out those key terms that tell you exactly what you need to be doing, and it's going to make your problems easier to solve, okay? The customer doesn't pay cash at the time of service, but instead promises to pay the $500 by March 31st. This is an AR. Doesn't pay cash at the time, okay? So we know this is going to be accounts receivable. They owe us cash, right? Okay, so that's why we create that account. That AR account is created to remind us they owe us cash. We've performed the service, we've earned it, but they owe us cash, okay? So what we're going to do is we're going to increase that asset account, and we're going to increase our revenue account. Okay, we can see that right here. We have a $500 increase to revenue or to assets, but we've also got that $500 increase to revenues. Okay, this keeps our equation in balance. We have an increase of $500 to assets, and in the end, we have an increase of $500 to equity because revenue increase equals an equity increase as well, right? Put SE here so we don't get confused with expenses. So pretty simple journal entry, pretty simple example to look at as far as AR goes. But let's look and see what happens when they collect the $500. What happens when we collect? So on March 31st, again, paying attention to the dates. This has been a month. This has been 30 days, right? This is important if we need to know that 210 net 30, right? That becomes important. Right now, we don't need to know that, but it does become important. We collect the $500 from the customer. Again, pay attention to your amounts. The amounts are important. What if we only collected $475, right? So pay attention to those as well as we go along. So what's happened? Well, we increased our asset by $500. That was cash, and we decreased accounts receivable by $500. So we increase cash, we're going to decrease AR. What has happened here? Well, we increased assets by $500, but we also decreased assets by $500, right? So we have that net zero impact, and you can see that right here, net zero, okay? So again, this is not a journal entry we are not familiar with. This is something we've been doing really since the beginning of the class, right? So something we should be fairly familiar with. If you're not, if you do have questions, don't feel bad. Just get a hold of me and ask, okay? So the next thing we're going to talk about is allowance method. And what this does is this is telling us that we have some uncollectible accounts, right? What does an uncollectible account mean? Well, it just means we don't think we're going to be able to get that cash. We don't think that for whatever reason, that customer is going to actually give us the cash. Now, GAAP, if we all remember what GAAP is, basically, you know, the rules, right? GAAP requires us to account for those uncollectible accounts using something we call the allowance method, okay? Now, this can be somewhat confusing if you do not pay close attention and you don't, if you're not really grasping this concept, it's okay. It happens. It takes a little bit of time to wrap your mind around this one. This can be a little bit of a confusing subject. But what we're required to do is use the allowance method. And when we use that amount allowance method, we have to do the following things. We estimate an amount of our current, and this is an extremely important word right here, current AR that we believe will become uncollectible. Now, there are a couple of different ways we can do that. Okay, we're going to do the simple way. Then we report this estimate as a contra asset. I told you guys this would become important again when we were talking about depreciation and accumulated depreciation. We have other contra asset accounts. One of those is your allowance for uncollectible accounts. Okay, so just a reminder here that the contra asset account holds the opposite normal balance from your asset accounts. So they reduce the value of the asset. So in this case, we're going to have AR sitting here like this, and we'll have our allowance sitting right beside it, hugging it ever so tightly so that we know that this is here to reduce this account. Okay? So under the allowance method, we always report AR as the net amount. That is why when you look on your balance sheet, you'll see it listed as accounts receivable net of allowance. Is typically how you will see that presented. Okay, and that's because we're taking this account right here into effect. We're taking it into consideration and saying, yeah, we have $1,000 in AR, but we think $100 of that is uncollectible. Okay, so we really think we're only going to collect about $900 of it. So how exactly do we apply the allowance method? Okay, we follow this process. Okay, at the end of the initial year, we establish an allowance by estimating future uncollectible accounts. Okay, and we will walk through an example of this. So don't feel like you're not getting it yet. We will walk through an example. Okay. Step 2 is during the next year, the subsequent year, right? We write off the actual bad debt as uncollectible. Here's an important note. This is extremely important. Your actual write-offs may differ from the previous year's estimate, okay? So if you're writing off, if your bad debt expense is more than your allowance, that means you've probably underestimated the amount that you would need to write off. If your allowance is higher than your bad debt expense, you maybe overestimated. Maybe you've got better customers than you thought, okay? And then we'll just start back. Basically, you start back at step 1, and at the end of this year, this subsequent year, next year, you estimate the future uncollectible accounts. So basically what you're going to do is you're going to take the 20x1 ending balance, and you're going to say we have $1,000 here, and for whatever reason, we expect that $100 of it is uncollectible. So your new beginning balance for AR net is going to be $900, right? And then we'll write off however much we have. Maybe we write off $90 of it is what we actually didn't collect. And we collect, we end up our new ending balance in 20x2 is $800. And we say, you know what, maybe we're not going to collect $70 of that, right? So each year you just make an estimate based on the new ending balance of the current year. Okay, that's all that's saying. And then at the end of that year, we will write off that amount specifically. Okay. So, like I said, we're going to actually walk through an example here. Okay. So at the end of 2024, Kimsey is owed $20 million from customers and estimates that 30% will not be collected. Me, personally, I think 30% is a really high amount, but they're just using it as a way to keep the numbers easy for us, right? That's all this is about. This is just about keeping the numbers easy. Oops, sorry, guys. So they're going to say that we expect that $20 million, 30% of it will not get collected. So the calculation, now this is at the end of 2024, right? So this is your ending balance of 2024. We say that's $20 million, right? We're going to multiply that times 30%. That's going to give us $6 million. Okay? And that's what we've done right here. So we will create a bad debt expense. We're going to increase that expense and say, well, there's $6 million we're writing off. Okay? And we are going to make an allowance for that $6 million. We're just saying, we are allowing for $6 million to not be collected. We're just saying that's not that it's okay, but we expect it, right? So in the end, that is a decrease to an asset. Just remember that this is actually an increase to a contra asset, right? Which in turn becomes a decrease to the asset. So if you got any questions about that, I know it's a difficult one to wrap your mind around right now, but we'll continue. We'll work some more examples on that. We'll get a little deeper into it. But if you have any questions, please feel free to contact me.